Okay. Hello again, everybody. My name is Kevin Kelly. I'm the Director for Community Economic Development here at the Partnership. Also with me today is Ryan Gelman, the new Senior Associate for Public Policy and Advocacy here at the Partnership. Welcome to today's webinar, which is on the most recent proposed changes to the Community Reinvestment Act and the implications for low and moderate income communities. Joining us today are Kevin Hill, who's a CRA manager at the National Community Reinvestment Coalition, and one of our members, Alan Jennings, from the CAC of the Lehigh Valley in Bethlehem, Pennsylvania. I will now turn things over to Alan Jennings, who will get us kicked off for today.
Hello, my friends in Community Action. Thanks for being part of this. If you're on this call, you understand the power of CRA. And if that's the case, first thing I want to say is you should join the National Community Reinvestment Coalition. It's very cheap. It's a huge benefit. There are all kinds of ways that they do our work for us and with us. And I would encourage you to join NCRC. CRA is not about contributions. I want to make that clear. A lot of people think it's, they have CRA money out there and you want to get some of it. Charitable contributions are actually a small part of the law. Having said that, our agency is a $27 million organization and only about 30% of it comes from government sources. The rest of it comes from private sources. And most of that money, or a lot of that money, comes from banks. So, I don't want to sound like I'm contradicting myself. I just want to make it clear this is not about donations. This is about access to credit. On the other hand, helping banks gain access to our people, who they are required by federal law to serve, often can bring the contributions with it. It's a kind of capacity building thing that you go to them and say, look, we're going to bring you business customers, we're going to bring you home buyers, or we're going to bring you consumers, and the banks need our help to do that. So this is a very, very powerful law. I consider it to be the most significant tool in doing community economic development that the federal government has to offer, other than possibly maybe the contribution, the money that you can get from the feds. But, we all know that's not what it used to be. So I would argue that this law is the most powerful tool that we've got to bring justice to low-income neighborhoods. And that's what we are all about, I think, fundamentally. Is I always say charity is what you do when you don't have justice. We pursue justice. Charity is a homeless shelter. Justice is an affordable home. Charity is food assistance. Justice is a job that pays the bills. And there's nothing more powerful than CRA in helping us do that. So I'm glad you're on the call with us, or this webinar with us. This is a battle that we can't let others fight for us. This is something that we have to be on board for and make sure that this tool, as powerful as it is not weakened or diluted or redirected to people who don't need the affirmative support. So thanks for being on the webinar, and Kevin Hill is right there.
All right, thanks a lot, Alan, and thanks again, Kevin. I'm really glad to be here with all of you this afternoon or morning, depending on where you're calling in. Alan's 100% correct. The Community Reinvestment Act is a very important tool for letting us really have a voice in how banks are serving or not serving the neighborhoods that we're working in and living in. The Community Reinvestment Act requires banks to be proactive in taking steps to ensure that everyone has access to credit and capital in a safe and sound way. I am the CRA manager with the National Community Reinvestment Coalition. Basically, my job is to work with our members and national partners on our campaigns to get community benefits agreements, which we've had a fair amount of success in over the last couple of years. Recently signing a $60 billion community benefits agreement with Truist, which is the combination of BB&T and SunTrust. But today, and so far this year, I'm actually working much more on this campaign, which is the campaign to protect the Community Investment Act. Because as we'll get into in a second here, these are some pretty serious changes that are being proposed by the Trump administration appointees, particularly Joseph Otting, who is the current head of the Office of the Comptroller of the Currency, which regulates our largest banks. the OCC and the FDIC have released these proposed changes. So let's get right into it. Kevin mentioned at the start that you will see a box on the bottom right side of your screen that has Q&A. I will take a couple breaks during the presentation to answer some questions. So please do start typing up your questions in there. And Alan, who's joining me, he'll be jumping in and out to provide a little more context on the things I'm talking about. But let's go ahead and get started. We have a lot of ground to cover today. So just to start off, the OCC and the FDIC, as I was mentioning, they've released this Notice of Proposed Rulemaking, or NPR. It's a 240-page document. And this is actually a follow-up from 2018. In 2018, they released an ANPR, Advanced Notice of Proposed Rulemaking, which was kind of like a high-level look at what the OCC, at the time just the OCC, wanted to do to change how the Community Reinvestment Act gets implemented. And there was an open comment period in 2018, and about 1,500 comments were submitted. And of those 1,500 comments, 2/3 of them, so 1,000 of them, were advocating that we needed a stronger Community Reinvestment Act. A lot of comments noted how 98% of banks currently pass their exams, that all mergers and acquisitions that the banks apply for are basically granted. So people are saying, like, look, the CRA could be stronger and do a better job at really encouraging the financial industry to really make sure that they're not leaving groups and neighborhoods behind. Also, a big pushback was the OCC has this idea of really kind of changing how CRA works. CRA currently works, really briefly, by having 3 tests. The banks are analyzed on three separate tests, a lending test, an investment test, and a service test. Lending test is half the grade currently, which makes sense because we're trying to address redlining here. So the lending test evaluates how well the bank is lending to people with low to moderate incomes, to small businesses in neighborhoods that are mainly people with low to moderate income. Investment test is like community development investments. There's also the banks can get credit for philanthropy in that investment test. And then there's a service test, which looks at branches. So there's those 3 tests. They're all analyzed separately, which ensures a certain amount of each. And also, the CRA currently looks mainly at number of loans. It does not look at like dollar volume of loans for the most in terms of retail lending. It's really mainly looking at how many loans is a bank making. Well, the OCC approach, as we'll get into, but just to kind of summarize in a nutshell right now, is to move away from sort of 3 separate tests and to move to 1 test. When you combine all CRA activity together, and also focusing more on dollar volume instead of number of loans. And as I'll have more specifics, but that really is a fundamental change to CRA, which will have really far-ranging negative effects on nonprofits that are seeking to work with banks on community development projects, and it will have even a negative effect on encouraging loans to people with low to moderate incomes and small businesses, which tend to be smaller dollar volume. But I'll have more detail on that as we go into the presentation. The opening remarks, a lot of people are coming out now with their analysis and their take on these proposals. I just want to highlight this one commentary. There's a link there. I think that should be live if you want to click on that and read it later. But this is a quote from former FDIC Chairman Martin Gruenberg, where he's describing this proposal as deeply misconceived and would fundamentally undermine and weaken the Community Reinvestment Act. And I just want to point out that Martin Gruenberg is a respected former regulator, former head of the FDIC. And during his time at the FDIC, he was not necessarily known as the most progressive or left-leaning of folks. He was seen as a moderate guy, respected by most. But that just shows you that even sort of moderate professionals that are analyzing it are seeing this for what it is. And it is it's a big change in how the Community Reinvestment Act would work. And it stands to really fundamentally weaken it. And let's get into how it would do that. This to kind of organize our thoughts and organize and even how the NPR is kind of structured, the notice of proposed rulemaking, these changes. For the most part, we're talking about three topics here. There's what counts, which is kind of getting into like redefining what banks can get CRA credit for, and as we'll get into, this proposal is largely moving away from a focus on people with low to moderate incomes, adding in other things. Then there's where it counts. That's a big deal as well. Where it counts, as we'll get into, you really need CRA to be updated to really look more at where it counts, because when the CRA was passed in 1977, at the time, the banking industry was a much different industry than it is now. At the time, the banks were kind of limited in their activity of lending to just the areas where they had branches, because the deposits they would get from people depositing money into those branches really kind of dictated where they lend, and they were really kind of limited to lending just in communities where they had branches. And what was happening previous to the Community Reinvestment Act is in underserved communities, there actually was a tendency for banks to put a branch nearby an underserved community, frequently a community of color, and take deposits from those communities, but to not do any lending back. It was kind of just stripping deposits from areas to then lend in more prosperous areas, which has a really self-defeating prophecy kind of effect, because if you take money out of a community and never reinvest it back in through home loans and small business loans and support for nonprofits doing work in those areas, you're really kind of holding the people that live in those neighborhoods, those red line neighborhoods, back. Like, it'd be very, very difficult for people growing up there to be able to take part in the American dream and have a good, realistic chance of social mobility. So that's why the CRA is so important. But over time, in the world we're in today, banks are not limited near as much with their activities, and a lot of banks are out there that get a lot of their deposit dollars no longer from just regular branches but online. And so a lot of bank activity is not currently being regulated, because there's been the banks are not sort of limited to just where they have branches. So that's absolutely something that needs to be addressed in CRA reform. But as we'll get into, the proposed way of addressing it here in this proposal from the Trump regulators is not helpful. But I'll provide more detail on that when we get there. And then finally, the last section is how it counts. So we have what counts, where it counts, and then how. So after we've kind of calculated what we're going to count and where we're going to count it, how does it all sum up to a score or a rating for the bank? And we'll get into that. And the goals that the OCC and the FDIC have said, that they've stated that these are their main goals in this process, is to direct more CR activity to where it's needed most, to increase transparency, and to increase overall CR activity. And those are noble goals, and CRC has the same goals. The problem, though, is that this proposal will not do those things. At best, the impact that this proposal will have on those goals is unclear, but in most cases, this proposal will actually have the exact opposite effect of directing CRA resources where they're needed most and adding more transparency and increasing real CRA activity. I'm going to get into it now. My plan is to stop for questions after each section, and so you saw there's 3 sections. So just a reminder, folks, please do start typing up some questions if you have any in that Q&A section in the bottom right of your screen. So what counts? This is the first section, and the NPR proposes redefining community development to add in a bunch of things that are not currently there. And just as a quick refresher, all large banks and even intermediate-sized banks, so basically every bank, I believe every bank roughly about $600 million in assets and up. The thresholds change a bit for inflation, but I'm pretty sure currently it's about $600 million in assets and up. They're all required to do community development. It's not an option. They have to be in the business of community development because of the Community Reinvestment Act. And community development, it's loans, investments, Also grants, although grants are not technically required, but the banks can get credit for them. But loans and investments in community development are required of all banks above $600 million in assets. And so what is community development under CRA? Well, currently the CRA defines community development as affordable housing, as loans, financial assistance that helps organizations assist small businesses, either through the making of micro loans or technical assistance, community development financial institutions, CDFIs, those kinds of institutions. Community development is also defined as social services for low to moderate income folks, so like workforce development, VITA, housing counseling, financial counseling, credit counseling, all of that, as long as it's geared towards people with low to moderate incomes, and you can have some way of demonstrating that. That's what is currently defined as community development. Well, the Trump regulators want to change that. They want to add in a bunch of other things that banks would then get credit for doing and be analyzed on how well they're doing. And a lot of these things you'll see it's moving away from the traditional focus of CRA on people with low to moderate incomes. The big egregious example you see here on the slide, the NPR proposes giving banks CRA credit for stadiums. The caveat being it would have to be a stadium that was in an opportunity zone and a low to moderate income census tract. Unfortunately, though, that is a lot of stadiums. We did some analysis of this. We have actually an article out about this on our site. There's currently about 37 proposed stadiums just in professional sports in the United States. There's about 37 stadiums that are in some level of construction, either currently being constructed or about to be constructed. Of those 37 stadiums, I think about half of them would qualify as being CRA eligible here. And it's not just, some people think that this is just construction of stadiums, and some people may think like, okay, stadiums can bring jobs in and things like that. Well, first off, the scholarly research on the public benefit or the community development benefit of stadiums is very mixed. A lot of research says that there's really no long-term positive economic impact of stadiums. Some say that there's even some negative effects and possibly even displacement caused by stadiums. But this proposal here, it's important to keep in mind, it's not just for construction of stadiums. In fact, the example in the NPR where it talks about stadiums mentions improvements to stadiums. So let's say there's a stadium out there that needs a new jumbotron or wants to make their parking lot bigger. The bank could get CRA credit for financing that under this proposal, as long as that stadium is located in a low to moderate income census tract in an opportunity zone. That is, I think everyone on the phone on this call already knows how inappropriate that is, just because that's not what the CRA is about. It's not about stadiums and jumbotrons and things like that. But also, it's inappropriate because that's something banks would do in their regular course of business. That's a low-risk financial opportunity. The banks are going to do that in their normal course of business. We don't need to be encouraging and incentivizing that through the use of the Community Reinvestment Act, because they're going to do it anyways. So this is kind of like grade inflation. It's basically banks getting credit for stuff they would do anyways, which has dubious benefit for the community. Other things that would change is they want to allow banks to they want to make it easier for banks to get credit for infrastructure, so like bridges and things like that. There already are some elements of banks getting credit for that currently, but they want to make that easier. Financial literacy targeted to anyone, regardless of income. So say there was an organization out there that specialized in doing financial literacy or specialized in providing financial advice for high-income investors. If the banks gave a grant to that organization, they could call that community development. And also that would dilute any organization here that's actually trying to run a program for financial literacy to really reach people that need it most, people with low to moderate incomes. Programs like that will now be diluted because bank support will no longer require that it's being directed to people with low to moderate incomes. It's opening it up for anybody. So it's really just diluting initiatives designed to help people that need it most. Agricultural activity. The MPR decides that agricultural activity of any kind is community development. So any form of financing to an agricultural enterprise, regardless of its size, would be considered community development. The MPR cites an example of a bank financing an agricultural enterprise that makes $10 million a year and claiming it as a community development loan, regardless of any impact of whether it generated more jobs or anything like that. Just if it's agriculture, it's community development under this proposal. MPR would also change the definition of a small business. The CRA currently analyzes banks that are involved in commercial lending and evaluates them on how well they lend to small businesses. And the CRA currently defines a small business as any business that makes less than $1 million a year. Research has found that 95% of U.S. businesses fall under that $1 million a year threshold. But the MPR wants to change that. The MPR would move that threshold up to $2 million, which will inevitably discourage and at least disincentivize banks to be really proactive in working with nonprofits to get more capital out to businesses under $1 million, the businesses that need the most assistance. So again, we're just seeing a trend here, moving away, and also making it easier for banks because we're expanding the stuff they can get credit for and things like that. There's also they also want to redefine affordable housing, and I posted here in complete detail the definition, the new definition they provide for affordable housing. Currently, for banks to get credit for financing affordable housing, so say that a bank wants to get credit for financing a new apartment building you have going up in your community. The bank would only currently get CRA credit for that loan if they can demonstrate that people with low to moderate incomes are getting some of those units in that new rental housing property. And there's various ways that the banks have demonstrating that happens. This would change that, though. This would give banks credit for ensuring that affordable housing is available based entirely just on the rent. So if it's put here, if they put their rent to not exceed 30% of 80% of the area median income, you could call it affordable housing, regardless of who gets those units. So let's say an apartment building is going up in sort of like a nicer part of town in your community. It's a part of town that a lot of wealthier people frequent and hang out in. And those wealthier people happen to hear about first that this new apartment building, this new rental housing place is coming up, and they hear that, oh, it has some cheaper rents. Those wealthier people could get that discount, and that's what we'd be calling affordable housing in 2020 now. It'd be discounts for potentially people that don't need the discount, or at least don't need it near as much as actual people with low to moderate income. So that's a pretty radical redefinition of affordable housing. And again, when you think about it, you have to ask yourself, do these changes accomplish the goal of directing CRA resources where they're needed most? Is improvements to stadiums what is needed most? Are we actually increasing CRA activity here, or are we just redefining it? Yes, CRA activity will go up if you change dramatically what counts as CRA activity. But is that a real increase, or is this just artificial? I'm going to stop here and try to answer a couple questions. Sandy writes, does the size of the bank change the CRA goals? I had two small banks, now intermediate-sized bank, call me recently. Yes, the answer is yes. I'm trying not to do too much nitty-gritty details of what the CRA currently is, but I can provide a quick answer to that. Yeah, there are three sizes of banks. There's small banks, which I believe it's about $600 million in assets and below are the small banks. And the small banks have less of an obligation or CRA. The small banks basically just have to demonstrate that they're making loans they're making loans where they have branches. They're not just taking branches and lending in other places entirely. So it's a very basic, all right, you have these branches, you're making loans in that area, and you basically pass if they find that you are making loans in that area. Once you're at that $600 million to $1.3 billion, that's the intermediate size threshold. then you start having a community development component. But it's community development joined together. So you still have a lending test, and you basically have like a community development test, where you're required then to be making loans and investments in community development. And then the large banks, which is everyone above that 1.3 billion roughly threshold, they have the three separate tests, where they have the lending test, where it looks at their retail lending, as well as a requirement that they make community development loans. And they have an investment test, which looks at community development investments and also gives credit for grants. And then something new for them, they have a service test, which looks at where you have branches, and do you have a reasonable number of branches in low to medium census tracts. All right, I'm going to do one more question, and then I'm going to move on. But keep sending in your questions, folks. Sandy writes, most of the Illinois clients cannot even afford to go to the stadiums. Absolutely. Stadiums is not CRA. Stadiums is not community development. It's not. It's not. So thank you, Sandy. All right, so I'm going to move on. Where it counts. It's the second section. And as I said at the beginning, CRA reform has to address this issue of assessment areas, since a lot of bank activity now is done in communities where banks don't have branches. And this is a big deal. There's a lot of research during the housing crisis. The studies found that, so remember, banks are only currently regulated in the activities where they have branches. So where the markets where they have branches, their lending is analyzed for safety and soundness and for ensuring that they're making loans available to people with low to moderate incomes, all in a safe and sound way. And safe and sound meaning not likely to result in foreclosure, default, and things like that. And so only looked at, though, where the banks have branches. So in the housing crisis, we have banks that were lending in their markets where they have branches and they're being CRA regulated. And then the same banks were lending in other markets where they didn't have branches. And studies found that same bank, same time, different markets though. In the markets where they were CRA regulated, where they had branches, the loans that bank made was less likely to result in foreclosure than the loans the same bank's making in other parts of the country where they don't have branches and they're not CRA regulated. So the CRA actually was helped lessen some of the impact of the housing crisis, because it was where the bank's activity was being lended or being looked at and there was oversight. Those loans were less likely to result in foreclosure. So that's one of the strong reasons why we need to update the Community Reinvestment Act, because we know there's still predatory lending going on, and this has been found to be a deterrent to predatory lending. Also, too, access to home ownership and small businesses and small business capital is really kind of the best hope for folks to have sustained wealth and to really have that access to actual wealth and a real asset. And so we want to make sure that those building blocks and those towers or those ladders of social mobility are open to everybody, or else we're going to have a very, very unequal society. So that's why we have the Community Investment Act, and that's why we wanted to apply to as much of the marketplace for capital as possible, because it's so important. So that's why we need a good proposal for addressing this and kind of ending all the blind spots that are currently out there. And the NPR lays out a proposal for doing so, but this proposal, as we'll get into, is unworkable and would actually reduce transparency. So let's talk about that proposal right now. The proposal would say that all banks now must start collecting the physical addresses of the people that deposit into them. So currently, at least from what information is available publicly, you can look up the branches of a bank, and you can actually look up this is how many deposit dollars are considered held at that branch, which is a good measure of basically saying, okay, you can look up all you can look up all of a bank's branches in your community, and you can say, with using those numbers, you can say, like, oh, my community accounts for 20% of this bank's deposits, which is useful because then you can say, like, well, maybe my community should account for about 20% of that bank's community development and things like that. But this proposal wants to change and move away from looking at kind of the deposit dollars at a branch level and move it more to a household level. So the banks would be required to start getting information on where the households are of the people that deposit money into them. Also, all banks would have to do that under this new proposal. And then for the banks that gather, basically for your internet banks, your non-traditional banks, the banks that gather 50% or more of their deposits from outside traditional branches, they would be required, so after we collect all the physical addresses of the depositors, and say in the city of Pittsburgh, say in Pittsburgh, after you did that, you found out that 5% of my deposits came from households that are in Pittsburgh. So in that example, then Pittsburgh is going to be a new assessment area for that bank, and that bank is going to be analyzed on how well they're lending and doing community development in that community, because it's 5% or more of their deposits. Well, one big problem with this approach, that deposit information is not currently collected at the physical address level. So this proposal hinges on data that is not currently available. And the NPR acknowledges this and claims that physical addresses of depositors is readily available but not currently reported in an integrated and accessible manner. And also the regulators have even taken steps now to try to kind of like a dual track system of trying to get comments on getting this new information, which is also a key part of this other proposal. So it's just really bad policy making that's going on right now. But that's not the only reason that this physical address of depositors is not a good proposal. The main reason that we think this is a very bad idea is because this is a major move away from transparency. If the banks have physical address to deposit information, they're highly unlikely to share that with the public. When NCRC has tried in the past to get more reporting and disclosure on things like the Home Mortgage Disclosure Act, the banking industry, you can basically set your watch on what they're going to say. They're going to say, hey, we can't do that because that's going to trigger confidentiality concerns. And they're highly likely to do that again. So if they have this information on the physical address of their depositors, it's highly doubtful that information is going to get shared with the public. So if that information isn't shared with the public, and that information is what determines if a bank has an obligation to your community, the community members of all communities now are basically going to be left open to guessing if banks have an obligation to serve and lend in their communities or not. Banks that have branches in your community, they would still have the same things. But for the internet banks out there, which everyone acknowledges is a major issue that needs to be addressed, their commitments, the communities that they have an obligation to would be total guesswork. You would have to wait until a CRA exam came out in order to know if over the past 3 years you could have been having a conversation with a bank about a new program or the thing that's been really helping people get access to credit and capital. You would have to just guess, because you would not know if the bank had an obligation because this wouldn't be publicly available. Also, CRA exams look backwards, so they're looking at activity over the past 3 or 4 years. There's no guarantee that physical addresses of depositors are going to stay the same for 3 or 4 years, especially if you're right at that 5% threshold. So this would basically just turn CRA into a guessing game for these internet banks. It'd be a guessing game of, does this bank have an obligation in my community or not? That's just not a good proposal. And so we believe, and CRC believes, that a far better approach would be to base this on lending, where additional assessment areas, additional obligations will be created if a bank's lending activity accounts for a certain percentage of an area's total lending. So let's stay in Pittsburgh for our example. Let's say a bank we look at a bank's lending activity and we find, hey, this bank accounts for 5% of this type of loan in the city of, in the Pittsburgh MSA, or city of Pittsburgh. That bank should then have an obligation and be analyzed on a regular basis of how well they're making credit available and how much community development they're doing in Pittsburgh. We think that's a much better approach for a number of reasons. The big reason that's already information that's collected. The good old Home Mortgage Disclosure Act, which I mentioned already, that's been in place for decades now, and banks are already familiar with it. They report it. Also, with a little bit of training, a lot of people can be trained on how to look that up themselves. It's been around long enough. It's not the most user-friendly thing, but it's not the most hardest thing in the world either to kind of figure out and pull, okay, these are home mortgage disclosure numbers. It's ready, it's publicly available, it's there, infrastructure is already in place. Not like this deposit thing at all. Also, too, it just kind of makes sense that if a bank is doing a significant amount of lending in your community, that there should then be some analysis of, okay, it has a significant amount of lending, it's a significant actor in this field that's so important to reducing inequality and having social mobility. We should be taking steps to ensure that this bank that's such a major player in this such important market is doing so in an equitable and fair way, and at least in a non-discriminatory way. So that's why we really think that lending is actually a much better approach than the proposed approach. Also, this is a radical change here. The NPR also opens up credit for activities conducted anywhere in the country. Banks would no longer be required to kind of serve their local communities first, or just entirely have all their community development where they have branches. Banks would now be able to get credit anywhere in the country. And remember, we'll get more into this in a bit, but we're moving to a dollar volume-based approach. So we're moving to a dollar volume-based approach, and where banks can get any credit for anything in the country, anywhere in the country, regardless if they have a branch there or not. And we're letting banks get credit for things like stadiums and infrastructure. This is going to create a huge disincentive for banks to work on, like the things that CRA was designed to protect, like home mortgage loans for people with low to moderate incomes, small business loans. Those kinds of things are going to be discouraged because we're moving entirely to dollar volume, and I can get credit anywhere, and I can get credit for things like stadiums. This is a fundamental change on how CRA will work. We also know that this will likely lead, not all banks, but many banks, to seek to support national intermediaries that can put together the largest deals instead of working with locally based nonprofits. And the OCC and the FDIC, if they were listening today, may respond by saying, hey, we addressed that because they do have some stuff in their scoring methodologies that do have some, requirements for their local markets, which I'll get into in a second here in the last section. But it's important to keep in mind, as we'll get into, the banks only need to pass, they only need to be doing significant CR activity in half of their assessment areas under this proposal. So this is where we're at so far. You can get credit anywhere. It's all about dollar volume, and I only need to really worry about half my assessment areas. And also, the public's not going to know, if I'm an internet bank, which communities I have an obligation to. So that's where we're going here with these proposals. And now I'm going to take a break for a couple questions. Andrea, is it possible to offer a poverty simulation to the staff/decision makers at NPR? Is it just they have lost all sense of what it means to be impoverished low? Yeah, so Andrea, she's asking basically like, how can we wake up, the OCC and the FDIC? And I think that the OCC and the FDIC largely wrote this proposal for banks. I think that's the constituency they're writing for right now. When you look at all these, I really don't think they really have much of the community's interest at heart in these proposals. And I encourage all of you, as we'll get into the end, to make your voices heard, and to highlight which of these issues are the most concerning to you, and also your ideas for improving the CRA that are better than these. But I'll move on. I'll do one more question. And it looks like, all right, keep the questions coming. So I'm going to move on. Okay, so this is our final section. This is the how it counts. So after we've figured out where we're counting and what we're counting, how are we counting it? what does it all add up to? This formula you see here, this is basically the main thing right here. They call this the presumptive rating. This is the calculation that the banks would do to determine their overall score. And there's a little more than this, but this is the overall kind of, am I in the right place? Am I passing CRA performance or not? And so looking at the left side of this equation, you see qualifying activities. So we're adding everything together. We're moving away from 3 separate tests. We're adding it all together. And we're dividing it by retail domestic deposits. So that's the first thing we do, left side of the equation. And then there is this thing on the right for branches, which I'm gonna put it to the side for a bit. I will get there, but I'm gonna put it to the side for a bit. The thing on the right about branches. But so you would have to get to a place where all of the CRA activities you were doing, divided by your deposits, would get you to a certain score, which is very, very, very similar to what the OCC put out in 2018, and about 1,000 comments got submitted saying, don't do that, like do not do this, because we knew it would be such a discouragement from and moving away from how CRA currently is. So the OCC's response has been, okay, we still are going to mainly do that, but we're going to change it up and add in some other stuff, which I'll get into now. And banks would also need to pass this retail lending test in half of their assessment areas, just half, in half their assessment areas, and ensure 2% of deposits to community loan activity, both overall, so in on their entire activity, and in half of their assessment areas. And remember that qualifying activities value, that's from anywhere in the country. That is not just where they have branches. That is for anything in the country that the bank decides to finance, they can throw in there. And they would need to get to, this is the breakdown of where they would need to get. 11% and up would be outstanding. 6 to 10 would be satisfactory, and under 6 is failing. So basically, the bank needs to get to 6 in order to be passing in this proposal, and gets 11 to be outstanding. And in their assessment areas, the banks would have to pass this test. Either one. It's one or the other. You don't have to pass both. It's one or the other. And to simplify, this is probably the most complicated and hardest thing to talk through, particularly on a webinar with about 50 people. But to quickly summarize, basically what these fractions are saying is one is comparing a bank's activity to the demographics of an area. That's the 55% one on top, and the other one is comparing to basically peer or market. And in a nutshell, the first one is if you're so you find out the percentage of, let's just use small business because it's a little simpler. So you find out the percentage of small businesses in an area, and then you find out the percentage of your bank's loans in that area that went to small businesses, and whatever that percentage is, as long as it's better than the percentage of the small businesses in the area times 55%, so half, as long as it's better than basically half that percentage of half whatever the percentage of small businesses in the area, then you pass. Or there's another way you can pass. Or if you find out what's the percentage of loans that have gone to small businesses. And you can also say people with low to moderate incomes, whatever you're looking at the moment. So you take that percentage of loans in your community that went to small businesses, and then you times that by 65%. And as long as your bank's percentage of loans to small businesses was better than 65%, you passed. So you either have to be better than 65% or better than 55%, and you pass. And you'd also need to ensure that 2% of your deposits to community activity in half your assessment areas. So you have to do this in half. You have to be basically half of the total percentage, or 65% of the total percentage of loans in half your assessment areas to also pass. In addition to that equation getting you to that threshold. So first problem is combining CRA activity like that, throwing it all into one bucket, and combined with dollar volume, combined with needing to get to 6, all of that just incentivizes banks to pursue large deals, which will disincentivize the very thing CRA was designed to protect. And combining with I can do this large deal anywhere, doesn't even have to be like where I have branches, this is a major change to CRA. And the OCC and the FDIC even considered placing a limit on how much any single transaction could influence the bank rating after many comments were submitted in 2018 that raised this as an issue, but they ultimately decided against doing that. So one transaction, particularly with a bank that doesn't have a lot of deposits, so think your smaller sized banks out there, for them, they could almost complete their CRA activity in just one transaction now, one or two transactions. Also, there's other ridiculous things that are going on here. This is one of the most just ridiculous ones, this first bullet here. The NPR suggests adding a multiplier of 2 to most ways that banks currently pursue CRA community development. Let's think about that for a second. So the point of community development for CRA is to incentivize banks to do things that are needed in the community. So we kind of have like the original, or like the original CRA right now, of the original community development stuff, which is like affordable housing, helping small business organizations, getting social services out there. So the original stuff they're proposing, we'll times that by 2, because we want to really encourage people to do the original stuff, but we also want to get banks to get credit for all this new crazy stuff like stadiums. But it'll work out, don't worry, because we'll add a multiplier of 2 to the good stuff, so people will do the good stuff. So it really makes me wonder, why are we even adding in this other stuff in the first place if we have to create a multiplier for the good stuff? Also, even more concerning, if I'm a bank and I pass my CRA exams regularly, which 98% of banks do, and I've just heard, hey, I'm going to give you the same amount of credit, but you can cut that in half, which is what adding a multiplier of 2 does. Like, you're just telling banks you can cut that thing and cut your community development in half, cut your resources for affordable housing, cut your resources for social services, cut it in half, and you can still get the same amount of credit. And that's a scenario the NPR even acknowledges could happen, and they requested feedback on. So this is just, I think this in a nutshell just shows how just this is not a serious proposal, and this is a very dangerous proposal because of the effects this will have on community development. The OCC and the FDIC also, you remember, let me go back a second, or never mind, let me stay here. You remember those thresholds, the 11% and up is outstanding, the 6% and up is satisfactory? Well, apparently the OCC and the FDIC studied how banks would currently line up on those thresholds, but they didn't release any of the results. They just said, we studied it, but none of the results of that study were released. So without that, how do we know if those thresholds actually are going to increase CRA activity? Will they increase? Like, will they encourage? Like, are there a bunch of banks out there that currently would now be needs to improve and would need to increase CRA activity to get to satisfactory? Or are there a bunch of banks out there that would be outstanding, that are currently outstanding, but after this proposal would be satisfactory? Or is it the opposite? Is it the opposite, where there's a lot of banks out there that are currently satisfactory, which would now be outstanding? Or there's banks out there that are barely outstanding, which now are going to be outstanding forever because of this proposal. So we have FOIA'd. We've sent in a Freedom of Information Act request to get the results of this study, because we're really concerned that and we've also, our research team is working, as you can imagine, almost entirely on this at the moment. And we've started to pull together some analysis based on these proposals of how this would break down, and how banks, if this was CRA today, how would banks break down under these thresholds? And that's not complete yet, but I can tell you from the preliminary analysis, we're still dotting our I's and crossing our T's, but I can tell you from the preliminary analysis that most banks are going to easily pass these thresholds. Easily. Also, another thing that I don't have a bullet point on here because it's kind of a point of the NPR that we've recently kind of uncovered, because this is not an easy document to read. The NPR proposes a pretty dramatic change to CRA like this, too. Currently, CRA looks at new loans that are coming up in the evaluation period, which is about 3 to 4 years. They're looking at new mortgages being made, new small business loans being made, and they're giving credit for those new loans being made, as long as they are done in a safe and sound way. This proposal wants to take a balance sheet approach, and it's dollar volume. So instead of giving credit for new loans being made, they're just going to look at, okay, what is the total value of mortgages or small business loans that you're currently holding that are small businesses or low to moderate income? So if the bank decides not to hold some loans, they could get credit for those loans for the entire term of the loan. As it gets paid down, it would go down, but the entire outstanding term of the loan, they could get credit for. So if a bank decides to start holding, a mortgage like 25 to 30-year mortgages, they then can get credit for that one loan they made for 25 or 30 years. It's a balance sheet approach. It's no longer just looking at that new stuff that's happening. This would dramatically decrease banks' needs to actively pursue new loans to small businesses and people with low to moderate incomes. It's a pretty dramatic change. And then one other thing, I want to go back to the branches. So I'm going back here on the right side of the equation. This is the replacement of the service test. They got a lot of flack in 2018 for basically not having any way of bringing branches into it. So this is their answer. This is how we're going to bring in branches. You're going to divide the number of branches you have in low to moderate income areas by your total branches. So you're going to find out the percentage of the branches you have in low to moderate income areas, and then you're going to multiply it by 0.01. And so let's run through an example of that really quick. Let's say there's a bank out there that has 30% of their branches in low to moderate income census tracts, which, by the way, would be quite impressive, relatively speaking, because most banks fall in at about 10 to 15% of their branches in low to moderate income census tracts. So let's say there's a high-performing bank out there doing 30% of its branches in low to moderate income census tracts. Let's run it through the formula. 30% times 0.01 gets you 0.3. And remember, you got to get to 6 at least. And you're only going to get a 0.3 from all those branches that you put in low to moderate income census tracts. So what's that going to do? That is going to massively discourage banks from having branches in low to moderate census tracts because it's not just going to matter as much anymore. It's hardly going to matter at all. Currently, it's about 25% of any large bank's CRA score is how many branches do you have in low to moderate income census tracts. So we're going from 25% of your score to like a point, like a percentage point, like a little decimal point, when you need to get to 6. This will lead to massive branch loss in low to moderate income communities because there's just going to be hardly any incentive for the banks to keep the access to services there in those communities. That's a pretty scary idea because we also know how much bank branches are needed. The FDIC's own study they release every other year, the study that unbanked and underserved, consistently finds every other year that bank branches are still a very important way and the main way a lot of people in underserved areas, particularly rural areas, are accessing their bank accounts and getting information about credit and capital and mortgage lending opportunities and things like that. So this is a pretty significant change here. Estimated loss of I'm almost done, so I'm gonna just plow through the rest of the slides I have. It's about 3, and then I'll stop finally for questions. The estimated losses here are huge. We have forecasted that if this proposal comes in and weakens CRA, across the country, we're forecasting a loss of $52 to $105 billion over 5 years in low to moderate income census tracts, and that's just looking at home mortgage and small business loans. That doesn't even account for community development loans and investments or philanthropy. Does not account for that at all. So that is that is untold. That is untold families that aren't going to have access to home buyer counseling because it just doesn't get funded as much anymore. That is so many small businesses that will not be able to get the capital they need to hire more people and to really take off and build their businesses. This is a huge thing. This is nonprofits also it's not included in there, but we also know that that's going to be a huge blow for a lot of nonprofit agencies out there. Also, the NPR does not touch on many ways to make the Community Investment Act stronger. It's time the CRA exams start looking at race, as the law was originally intended. And we have proposals for how the CRA could do that. Also, community benefits agreements. The regulators currently ignore community benefits agreements and do not listen to them. We really think that's a misguided approach. We think community benefits agreements are the role model or the ideal way to do CRA. Because a good community benefits agreement is an agreement between a bank and nonprofit organizations and representatives and leaders in the community about specific measurable goals that people can look up and check progress on, and those goals are met through strategies and products and programs agreed on between the bank and the community. We just really feel like that's the best way to do CRA, and we think it's time that regulators start coming up with a process for bringing in these community benefits agreements. We know that it's not as simple as the regulators just, waving a wand one day and saying we're going to start recognizing community benefits agreements, but we think it's time we start figuring out a process for doing that. So finally, what can you do to keep this from happening? If not trying to put fear in people, but this is some scary stuff that's being talked about. And so if you got concerned in point of this presentation, we need you to comment. We need you to send as many comments as possible. You send organization comments and individual comments. Get your friends and colleagues and other organizations to comment. Because we really, at this point, with this open comment period, which is open until March 9th, we need to get as many comments as possible in that push back and reject these very dangerous and unhelpful proposals, and offer proposals for actually going the other way and making the CRA stronger. This is not hopeless. We have seen here, I'm running out of time, so you can bear with me for a couple more minutes. We have seen that we have had an impact on these proposals. We have been able to change the conversation for the better. There's still very negative things in here, but we have seen the impact of the comments that were submitted in 2018. And also, if it becomes necessary to take maybe possibly legal action at the end of this comment period, we're on a much better basis if we can point to hundreds and hundreds and hundreds of comments submitted by from the public that basically said, do this, and then the agencies did something else. Our best footing going forward is if we can point to a large amount of comments that were submitted that push back on these proposals. So in closing, we have that website NCRC's created, Treasurer CRA site, right there. There's a link there, but it's ncrc.org/TreasurerCRA. That site is like the one-stop shop for all things related to the Trump proposed changes to CRA. We have instructions there on how you can submit your comment letter. We have two versions, and probably more in the future, but we have a short version and a long version of a sample comment letter that you can modify and send in. We have toolkits on how to talk to local media about this. We have sample tweets you can use for social media. We even have some infographics on the benefits of CRA. We have tons of articles to research and things like that. It's a really good site, but most importantly, it has those resources to help you comment. So I really encourage you, please do that, because we really can't allow this to happen. These changes are significant. This is not tinkering around the edges. This is dramatically changing the Community Reinvestment Act for the worse. Kevin, do we have time for a couple more questions, or what do we have to do on time?
Yeah, go ahead.
Okay. All right. Bear with me a second. Would it be possible to get the slides to this presentation? I believe Kevin is sending them out, correct?
Yes, it usually takes a couple of days for the WebEx system to make the recording, but I say Monday or Tuesday, I can send this out to everybody.
Got it. Thank you. Okay, I don't see any other questions at this time. Alan, do you want to say any last words? Alan, you may have muted yourself.
Are we there? I just want to remind us, we cannot let other people do this work for us, folks. We've got to weigh in on this. NCRC needs us. We need the NCRC. So please step up and fight this battle with us.
Thank you, Alan. And thank you all.
This is Kevin. I just want to put in one plug here. NCRC also has an annual conference which is coming up in April. I know in the past it's been difficult for CAP agencies to go because it literally was right after David Bradley's conference here in Washington. And so there's a lot of time in D.C. and away from your offices. But this year it's later in the spring, and I've been talking with Jen Jones over at NCRC about the possibility of some discounted rates for community action agencies. So I'll get back with her. There's going to be a little note about this with a link to the registration on their website in my e-news, which will be sent out a week from tomorrow, the last day of January, so you can take a look at that as well. I've been myself several times over the years, and it's well worth your time.
Thank you, Kevin.
Yeah. And that's all I've got. I guess no other questions have come in, so I want to thank everybody for being on, and I want to thank our two speakers, Kevin and Alan, for participating today. And please follow through and submit comments as was suggested in today's talk. Take care now.